Gucci sales plunge, Kering's design dilemma. Are we witnessing the downfall of a luxury fashion icon? Gucci, long celebrated for its cutting-edge style and plush designs, has just seen its sales plummet at a time when many believed the brand was untouchable. But here's where it gets controversial. The iconic Italian house, owned by Kering, is now undertaking its second major design overhaul in just 3 years, leaving both fashion insiders and dedicated fans wondering if constant reinvention is helping or hurting the brand. According to a statement released by Kering SA, https bloomberg.com/quote/KER, on July 29, 2025 at 11:46 a.m. EDT, and further updated on July 30, 2025 at 3:04 a.m. EDT, https bloomberg.com/news terminal T063RTVI5MU. Gucci's revenue took a steep 25% tumble in the second quarter, aligning exactly with analysts' predictions. https bloomberg.com/news/terminal T03QVNGQ1YYF. Overall, Kering's total sales also dropped by 15%, another figure that matched market expectations. Some observers suggest that the breakneck pace of design changes could be alienating loyal shoppers who still pine for the classic Gucci motifs. Yet others argue it's the only way to keep up with fast-evolving consumer tastes and emerging competitors. And this is the part most people miss. In a fiercely competitive luxury market, brands often face pressure to stay relevant by offering new, bold concepts. However, sudden shifts can cause confusion, especially for those who have invested heavily in the brand's previous aesthetic. Think about how other high-end labels have grappled with similar issues. Sometimes their reinventions are wildly successful, while at other times they alienate their consumer base. What do you think? Is Gucci risking its long-standing reputation in an attempt to capture the next wave of fashion-forward shoppers? Or is this exactly the push it needs to remain a leader in global luxury? Are you in favor of frequent design updates, or do you believe in preserving a signature look? Share your viewpoint in the comments. Your opinion might spark the next big debate in the fashion world. Kering's cost-cutting strategy, a deep dive into the luxury market. Kering's battle to regain its footing in the luxury market just got a whole lot more intense. After another disastrous quarter, the French conglomerate is escalating its cost-slashing moves even as it braces for the arrival of CEO Luca de Meo, a turnaround specialist notorious for trimming fat and restructuring companies. But here's the kicker. These drastic measures come at a time when Gucci's troubles show no signs of letting up. The first half of 2025 has been a roller coaster for Kering, with its net profit plummeting 46% year over year. The company detailed aggressive steps to curb spending, including shuttering stores, offloading prime real estate, and slashing its workforce. The financial strain is evident. Sales dipped 15% in Q2 to 3.7 billion euro, missing analyst expectations by 100 million euro. This downturn stems partly from Gucci's continued slump. Organic sales crashed 25% last quarter, as shoppers hold out for Demna's September collection debut. And this is where the strategy gets tricky. While some brands like Bottega Veneta managed tiny gains, 1%, others like Saint Laurent and the other houses division, including Balenciaga, saw declines of 10% and 16% respectively. LVMH's fashion arm, once a bright spot, also underperformed with a 9% sales drop. One controversial approach? Kering's refusal to unload underperforming brands despite rumors. While competitors like LVMH recently offloaded Off-White and Stella McCartney, Kering's leadership insists on resuscitating brands like Alexander McQueen through strict restructuring. We have clear strategies for every label and are focused on execution. Deputy CEO Duplay stated, leaving critics to wonder, is this stubbornness or strategic foresight? The cost-cutting crusade shows no signs of slowing. CFO Armelle Poulou revealed plans to close 80 stores this year, double the initial target, with 41 already shut in H1. Staff cuts have been even more aggressive, particularly at Gucci, where headcount sits 22% below 2022 peaks. Real estate moves are another cash lifeline. Kering raked in €1.5 billion from asset refinancing and expects €1.7 billion more by year-end, including a major Parisian property deal with Ardian. But challenges persist. Global luxury demand is forecast to drop 2 to 5% this year due to trade wars and economic uncertainty. Kering's Asian sales to irregular tourists and cautious consumers plummeted 19% in APAC and 29% in Japan. North America saw a milder 10% dip, partly cushioned by currency effects. The EU-US tariffs on luxury goods, effective post-deal, might pressure pricing. That is, if brands don't raise prices preemptively, as some did in Q2. All eyes are now on De Meo, who takes over September 15th. His automotive background raises questions. Can a cost killer seamlessly transition to luxury's creative high-stakes world? Analysts like Bernstein's Luca suggest his priorities include tackling Kering's debt mountain and possibly reworking its Valentino stake, a €1.7 billion investment that Mehula could exit below full value if 2025 targets lag. The road ahead looks rocky. Recurring operating profits dove 39% to €969 million, with margins shrinking to 12.8%. Meo's strategy remains under wraps. He's meeting internal stakeholders but won't unveil plans until 2026. Will Kering's austerity measures stifle brand innovation? Or could streamlined operations lay groundwork for a rebound? The stakes are higher than ever for De Meo's uphill battle. Should Kering reconsider its contradictions in crisis management? Share your take. Is holding on to all brands a sign of strength or denial? Breaking news. Kering's Q2 sales drop 15% as Gucci falls 25%. What's next for the luxury giant? The luxury sector is facing a reckoning, and Kering's latest earnings reveal just how deep the cracks run. While competitors like LVMH weather the storm, Kering's second quarter sales plummeted 15%, worse than the predicted 13% decline. But here's where it gets controversial. The company's plan to fight back? Another round of price hikes in its biggest markets. Let's break this down. Between April and June 2024, Kering, parent company of Gucci, Saint Laurent, and Balenciaga, generated €3.7 billion, $4.3 billion. That's a staggering 25% year-over-year nosedive for Gucci alone, which contributes most of the group's profits. For context, imagine a flagship Gucci store selling 1/4 fewer handbags and loafers compared to 2023. The plot thickens. CFO Armelle Poulou dropped 2 bombshells during the earnings call. First, Kering reduced its net debt by €1 billion this year through property sales and store closures, 80 locations slated to shutter by 2025. Second, and this is the part that's sparking debate, prices for Saint Laurent dresses and Bottega Veneta handbags could climb again this autumn, particularly in the US, where tariffs on EU imports recently jumped to 15%. But wait, you might ask, won't higher prices push customers away? Poulou insists the tariff impact is manageable, but critics argue this strategy risks alienating inflation-weary shoppers. Consider this. If a $3,000 Gucci Dionysus bag gets 10% pricier, does the brand's allure outweigh the sting? Kering seems to think so, betting that loyal clients will prioritize status symbols over budget concerns. The bigger picture? New CEO Luca de Meo, ex-Renault, faces a Herculean task when he takes the helm in September. China's sluggish luxury demand and global inflation have created a perfect storm. Meanwhile, Kering's stock has nosedived 60% since 2022, a crisis the Pinault family can't ignore. Now, over to you. Can premium brands like Gucci keep raising prices indefinitely? Or is Kering gambling with its reputation by treating tariffs as a pass-through cost? Share your take below. Is this smart business or luxury hubris in disguise?